Hello and welcome back to The Note. What is in the minds of the big investment institutions that largely control world capital markets? We've now had almost 5 years of the relief rally that followed the great crisis of 2008. But how have attitudes to risk changed? Are there any tectonic shifts to look forward to in the great asset allocation decisions between stocks, bonds and other asset classes? With me today is the ideal person to talk about this. He's the head of institutional investment for JPMorgan Asset Management, which has more than $1 trillion under management, Mike O'Brien. Mike, thanks very much for joining me today. Let's start with a basic look at the pie chart of how much money is out there and who is controlling it. What's your view of the institutional investment market?
The first thing, it's this chart here is what's been outsourced by these institutions to third-party money managers.
Right.
You can see here that the picture would be a lot bigger if you were to look at the total assets that these institutions have that they're overseeing. So the total market is about $75 trillion.
That's a lot of money.
A lot of money. Pensions, that's 17.3. In total, total assets would be about $33 trillion, which is actually up from about 28 since 2008. Insurance is 2.6 trillion. That's about the outsourced element from a total reserve pot of assets of about $25 trillion globally. Sovereigns, that's central banks, sovereign wealth funds. That 2.1 comes from a pie which is about 6 trillion of sovereign wealth funds and about 12 trillion of central banks. And endowments, that 1.2 comes from a total pie of around $3 trillion. So in total, it's a $75 trillion pool.
And broadly speaking, the needs and priorities of pension funds in particular have a particularly strong influence on how assets get allocated.
Absolutely. One, it's in the front of our minds every day from the media. Two, it impacts just the aging population and the baby boomers who are now hitting retirement. And three, there's a changing nature and changing shift on how a lot of pension funds are actually addressing their challenges, and we can talk about that.
Yeah, so let's take a look at that now. This is a chart from Towers Watson showing how asset allocation has changed. And interestingly, even though we've had two epic market busts or stock market busts during this period, allocation to equities remains remarkably constant. Perhaps the most notable thing to see here is that allocation to bonds has steadily gone down as people have moved into other assets.
Yeah.
Do you think that's going to continue? Why are we seeing that particular trend?
Well, one, there's two factors at play here. One is that the asset classes reflect market movements and, I guess, allocations of contributions and reallocations of asset classes. I would say that there is, in the current cycle, we're seeing as the yields start to increase, we will see an increase in allocation to fixed income, but it clearly has been coming down. Equities, I think, as a general point, and again, we've got a mixture of pension funds in here between both public and local authority and corporate pension funds. We will see the allocation of equities over time come down as the emphasis from pension funds is towards managing volatility of their contribution rate. This is, again, the corporate pension funds. And they're looking for greater diversification, and they're looking for greater source and certainty of cash flow.
Now that's interesting, given that we've had a lot of talk about the notion of a great rotation, that we've reached the top of a bonds bull market, that we'd steadily see a rotation out of bonds into stocks by these institutions. You're suggesting that might not be right.
Yeah, my view, and again, let's look at the two groupings, which are the corporate pension plans worldwide.
Yeah.
They've had a phenomenal 2013 in terms of yields rising, equity markets rising. So we've seen the funding levels in the primary defined benefit markets, pensions such as the US and the UK, come back to above 90%. So what it means is that there's now an opportunity for pension funds to take some risk off the table in terms of their equity exposure.
Right.
As yields increase and bonds become cheaper, they will start to rotate into bonds for hedging purposes to dampen the volatility of their funding levels. Right. And also they'll take the opportunity to get into other asset classes such as private equity, hedge funds, real estate, infrastructure and private credit, which we've seen pretty strong demand for over the past 24 months.
That's fascinating. Let's now just quickly to end off, take a look at this very interesting survey that one of your rivals, BNY Mellon, produced. This was talking to large institutions about their priorities. And one of the interesting things post-crisis is that more of them were now aiming for a particular overall return or to match their liabilities rather than trying to beat a market benchmark. Does that surprise you? Is that in line with your own experience?
Yeah, it's like everything. This is a snapshot in time. So what I would say is, I have to say I was surprised that the underperforming against liabilities came number 2. Again, if there are a number of public funds in here, that U.S. public funds clearly who are still orientated towards return generation, because that reflects the discount rate of the liabilities. I think achieving their return targets, I think that's always going to be an objective. I would have, if I had to take a blind guess, I'd have had that number 2 or 3 here. I think liabilities will continue the need to manage the volatility of solvency, the volatility of contribution rates will become the primary driver of investment policy for corporate pension plans around the world.
Okay, mate. Thank you very much indeed.
Thank you, John.
That's as broad a picture as we can give you in 5 minutes of the way big institutions are thinking. I think the main takeaway is it's not as positive a picture for stock markets as you might have thought.